I invest with debt. If I pick the wrong fund, I don't just lose money, I get liquidated. If I use margin on typical high yield funds like YieldMax, I would be broke. But there's one specific type of fund that defies the odds. Sure, the yield on some funds looks astronomical, but if you look at the share price, it crashes almost as much as it paid out. You aren't making money, you are just getting paid your own principal back. My fund pays a boring 12%, but the share price goes up. I will take the 12% that builds my account over the 50% that destroys it. The internet calls them all yield traps. Today I'm going to prove why the internet is lazy and break down the specific math behind the only high yield assets I trust with my life savings. I was going to give you a cute analogy about trees and barrels, but you don't need that. You just need to look at the charts. This is the only chart that matters for a margin investor. The blue line is a typical high-yield synthetic fund like Alti. The orange line is a physical fund like SPYI. The blue line screams 50% yield at you. That sounds amazing. But look at the direction of the line. It is a landslide. To pay you that yield, the fund is effectively liquidating its own assets. Now look at the orange line. It pays a boring 12%. But notice something? It didn't crash. It actually went up. It paid the distribution from profit, not principal. Want to see the full portfolio setup I'm using? Click the link below.